Well, good morning and welcome to TFR's very first cash management roundtable. Here I am with these wonderful experts here. We've all got together just after Cybos, where the themes of cash is king, or is this the crown slipping a bit? We don't quite know, but we're going to tease that out in our discussions this morning. Market volatility, a low interest rate environment, and all the opportunities and possibly threats posed by these fintechs that are sort of all circling around, opportunities for partnership and improving the overall client experience. What we have here today is a fantastic representation of banks from different parts of the world. So we've got Africa represented here, and we've got Europe represented here, and we've got America represented here. And our panellists are going to tell us all about their cash management challenges and what they're doing. And let's start with you, Daniel.
Yes, thanks so much, Clarissa. As introduction, so I'm Daniel Verbruggen from Bank of New York Mellon. I represent the relationship side of the business for EMEA. And we work closely with all continents, primarily from a US dollar clearing perspective, but also other currencies. So we cover global currencies from Europe and to other continents.
Sorry.
Thank you. Thanks for having me, Clarissa. Yes.
My pleasure.
My name is Søren Haugaard, and I am coming from Danske Bank in Copenhagen. We are indeed a European bank, but with a very strong Nordic footprint, and that is really where we see our point of departure. I'm responsible in our transaction banking for the relationship we have with our corporate clients across our network.
Thanks very much. Nkosi.
Thank you, Clarissa. I am Gosi Moyo. I'm with EcoBank. We are present in more than 30 countries across Africa. So we have the largest footprint on the continent. I look after cash management products and the sales part of the business, covering our corporate banking and commercial banking clients.
Thanks very much. That's great. I thought we'd kick off this morning with asking you all what your overall impressions were from the Cybos that we've just had. I thought that'd be rather interesting just to dig down a bit. What does this mean for cash management? And in particular, how is the corporate treasury experience being reshaped as a result of some of these new changes that are coming through? Anyone, just jump in.
Okay, I think from an EcoBank perspective, this is the fourth Cybos where we've come through and put up a stand, so we are still relatively new when compared to other banks. We are, from a cash management perspective, there is a lot of interest from our perspective in some of the newer trends around making payments quicker and more efficient across the continent. So I think over the last few days, we spent a lot of time in discussions with various partners or potential partners in terms of how we can make our solutions a lot more efficient, both internally and also from a cost perspective for our clients.
That's great. Daniel, what about you?
Yes, I would say that the big shift of thoughts are, if you compare it with Singapore, the fintechs made a comment about that they would take over banks.
They did. They were going to eat your lunch.
Yes, exactly, within 5 years. And I think this year...
Still there, isn't it?
Yes, hopefully. Well, we'll come back to that, I'm sure, in the course of the discussion. But at least this year, they're more open to collaboration with the banks, without whom they can't, I think, survive themselves in this more complex world.
Yeah, I agree. Well, do you agree with that, Sam?
I do, and I thought Cybos this year was very much about the cooperation, which has been a theme among the banks, all through, and I guess the basis and the foundation of SWIFT and Cybos. Yeah. Now the fintechs are there; they are more integrated, I would say, into the whole show. And corporates, I spoke to a number of corporates throughout the event. So the last 2 days, they were there, and they expect us to be able to work together across the industry. And with them really to sort of in a triangle to collaborate and develop new services.
Right. Now that leads us neatly on to the SWIFT Global Payments Innovation Initiative. And there's talk about phase 2, having all the information everybody needs up in the cloud. And that's coming through next year. What do you think about this GPII? Are you excited about it? Are you involved in it? What's going on?
Yeah, so Bank of New York Mellon, as you know, is one spearheading the effort with a number of banks. So there are approximately 20 banks on it. Going forward, maybe even 75. I would say there are three main key initiatives around this. First of all, it's about timing.
Yeah.
So it's related to faster payments or real-time payments.
Yeah.
So it's linked into there. Second point is predictability of funds flows and the routing. And so you could compare it to DHL, for example, where you track where your package is.
Yes.
You would do the same thing with your payment.
Yes.
And the last one is about charging. So cutting out the intermediaries, reducing costs, becoming more competitive as a financial institution, but also passing on that advantage to the corporate customers.
Are you passing the advantage on to your corporate customers? Is that how you see it?
Well, I see it both as that, but also in response to what the corporates ask for.
Yes.
They ask for exactly what Daniel is talking
Yeah.
about here, the transparency, the speed and the efficiency. And they actually then put something extra into it, which I think is what the GPI is responding to, namely to have it in a trusted format and in a network that is known to them, where I think that contrary to many of the fintechs and some of the discussions out there, you know, it's fantastic and there's many good ideas, but does it work? Does it actually meet all the requirements that we have? And you said, Clarissa, that there is a version 2 possibly coming up in 2017.
Yes, phase 2.
I know from my discussions with Swift that yes, there are indeed a lot of things happening there, and as Daniel was saying, you know, there's a group of 21 banks now spearheading this as pilots. We are one of them as well, and the reference group around that are now together with Swift designing these things, and we are now also starting to have dialogue with corporates more intense as to what is it actually that they would like to have in that.
And what's the African corporate perspective on this?
I think so. We, as EcoBank, we are also part of the initiative, although we are not in the pilot phase. We'll come into the phase after the pilot. I think the corporate expectation is the same as the European expectation, because some of them actually operate across continents. So whatever is delivered outside of Africa, they expect to have similar solutions within Africa. So it's the same expectation on speed. Transparency. The issue of fees is very, very key. I think we still see a wide variance from country to country in terms of the fees, especially for the cross-border transactions. So I think from a corporate perspective, there is an expectation that as we achieve these efficiencies, they'll also see a certain level of benefit from the solutions being implemented through this initiative.
I think if I may add, because I think you have a good point, that your corporates, your customers are global and working across multiple jurisdictions, so are the ones we service. And in response to their needs of having an efficient liquidity management, having an overview of their risk positions, be it in liquidity or FX or otherwise, servicing their customers and having a hold on their suppliers, this is a response to that. You know, making sure that we create that transparency and efficiency for our customers. And I guess you know, it's been very clear also during the week. You know, if Swift and the banks don't do it, then someone else will.
Right, this leads us neatly onto technology and some of the innovations that are coming through, so that the end user, the corporate treasurer, does have a full perspective on where their cash is anywhere in the world at all times, and where their payments have got to. As we agreed just now, real-time payments don't happen uniformly all over the world, only in certain parts of it. So what do you think about some of the innovations that are coming through? Are you working with fintechs? Are you developing your own platforms? Are you all getting together, coming up with common solutions? Because banks will talk to each other when they're managing cash, don't they?
Sure.
Yes, we have various projects going with the fintech world. If you look at what happened the last 3 years, I would say, it started off with the retail industry on the bank side, you know. So we saw the emergence of you know, PayPal, who was already there, but Apple Pay, attracting all those customers.
Yes.
And they may have underestimated the needs of the wholesale banking, the corporate world, in terms of risk mitigation and cash monitoring. So it's not that easy. So you need to replicate those solutions into a wholesale mode, if you like. Therefore, we have a number of proof of concepts going with you know, R3, with companies like Ripple, and there are others. We have now 6 innovation centers globally, and with various degrees of activity across a wide scope of use cases, whether it's touching cash management, liquidity, foreign exchange optimization. So to an extent, you could say it's a bit trial and error. I wouldn't say that we have already established a standard, far from it. We need to agree on that, but there is a lot of activity and investments.
You're discussing the distributed ledger technology, are you not?
Yes, absolutely. But we shouldn't restrict ourselves to distributed ledger technology and blockchain, to be very...
You've mentioned the B word.
Yeah, the B word, exactly. Because I think blockchain is more of a protocol.
Yes.
In a sense where protocol maybe sounds a little bit technical, but let's say a format containing information with some validation, comparable to SWIFT, whereas there are also other solutions out there beyond blockchain, because blockchain has addressed specific needs,
yes.
But there are other use cases where we wouldn't need a blockchain.
Guys, what are we thinking about all these innovations? Distributed ledger technology, blockchain, how does that interface with cash management? Excited about it? Are there some opportunities?
No, but I think, and I think there's, and that has also been a discussion point throughout the week. There is a misconception with many people that financial industry doesn't develop new things, that we are behind the curve.
Yes.
I mean, if you look at many of the fintechs, so-called fintechs, would have seed capital from banks, would have very strong cooperation with banks. So there's already a very efficient and active joint development going on as you said, Daniel, in many different areas, not just in the distributed ledger technology, but elsewhere, in the P2P sector, in the B2B sector, and probably in the B2B where we have the corporates. There's a discussion that we also have now in terms of, okay, so what is it we want to develop here? Do we really, and do customers really need to have instant payments, for instance? Or is the notion of having control and know where the funds are really the most important? So there's a lot of discussions going on there, and I get excited about it because obviously this is about creating new possibilities for us as banks to offer new services to our core customers. So that's exciting, I think.
And what are you getting involved in?
So we're starting to see quite a bit of interest in terms of the newer technologies around blockchain. I think from our side, there's also the regulatory aspect that we need to keep in mind.
Well, there is, yes, the regulation.
Yes.
Of course. You keep getting about that.
So I think our view is, I think we need to, so we are in discussion with a number of the fintech companies that are active in that space. And we're trying to see if we can find some smart partnerships in terms of, we need to create a certain level of market awareness, both from a banking perspective and also from a regulatory perspective. I think from a customer perspective, the customers, I think apart from the very large corporates, I think most of the customers would typically go with what the bank provides as a solution because they have that level of trust in that the bank will provide a solution that's stable and fully compliant. But we need to create that market awareness, and we need to get the regulators on board. So we are actually in discussion with some of the fintech players in terms of them actually coming into some of these countries so that we can run some workshops and jointly engage with the regulators in terms of trying to see how we can move this forward.
Excellent.
I would like to add to that. We should not underestimate what's happening in the corporate world. No. So this week with Cybers, we have been very focused on what's happening in the banking environment, regulatory environment. But the larger multinationals who have an open account supply chain financing solution in place, be it in the old world, are also thinking about, the new technology.
It's quite expensive for them, isn't it, the platforms they've got?
Well,
a lot of legacy investments gone in. I don't want to dive too much into supply chain finance. We are trying to keep on top of the cash. But yeah, I think the principles remain the same, do they not? That you've got a lot of investment in legacy systems that have gone on for many decades. And do you start again? Do you work with the technology you've got? Do you amend it, and so on? So we can come back to some of that and look at some of the technology that's leapfrogging. And I think the retail side of things is worth discussing further, because that does set expectations for end users and clients. As you say, you can't always have wholesale doing something different from someone's experience on their iPhone. Let's move on to liquidity risk management. Let's come back to this business of the corporate treasurer's daily challenge. Have they got enough cash to run the payroll? Have they got too much that could be earning interest if there's any interest to be earned in this environment elsewhere? And how do they balance that sort of tightrope of money to meet the liabilities and responsible custody of piles of cash? What are they telling you?
Okay, so I think and again, it varies from corporate to corporate. So we have some corporates who run the global treasuries out of Europe, the US, and elsewhere. So there is one of the major demands is on the visibility. So just making sure that they can see at the beginning of each day all their balances across worldwide on a single interface. So we see a lot of banks in the continent providing those solutions through the Swift MT940s. I think the liquidity side, it's from a bank perspective, there is the usual support through short-term financing or longer-term financing. So I think the banks try to cover both aspects of it, and aligned to that is obviously making sure that they have the efficient systems for both their receivables so that they get inflows a lot quicker, and also efficient processing of their payments. We are seeing an increasing demand for banks to provide cash flow forecasting solutions.
Really?
So instead of the bigger corporates can invest in the SAP, Oracles, and the other ERP systems. But even then, if they're operating across a number of countries, some of the countries are too small to justify that investment. So now they're looking at banks to provide more cash flow forecasting support through the internet or electronic banking platforms.
How do you do it then?
It is, I think, so it's a case of there are already existing solutions. So it's a case of how do you adapt those solutions into your existing internet banking platform. So from our side, we are in discussions with some of the service providers who already have built-in solutions, and it's a case of trying to see how easily you can integrate that. Because obviously we are trying to avoid developing anything which is completely new when we can leverage something that has already been developed and is working efficiently.
Is that your experience?
Well, I would first say, if you look at what happened the last 15 years, Clarissa, and you may remember, you have run surveys among corporates.
Oh, yes.
And one of the problems was always, okay, how can we enrich the data? And we have Swift 940 or 950.
Yeah.
What else can banks do? And it has been a recurring theme, and we have never been able to solve it. So I think with the current new technology, we have finally a catalyst, which will oblige us to enrich that data and bring added value to the companies. To your other question about the liquidity and the fact that companies are cash rich, in general, and that's commonly known. However, that may be true for the larger multinationals, the larger regional corporates working across maybe 6-7 countries. But once you look at the smaller SMEs, the smaller and the medium-sized enterprises, clearly they still suffer from the crisis where they're being squeezed in the working capital cycle. Undergoing pressure from the larger corporates while not being able to pre-finance their export or their import. So there is still a big need there. So I would make a distinction between both groups, the large corporates and the smaller SMEs.
Okay, that's a very good point.
Actually, I think that's an important distinction here. And we tend to, when we have these discussions, think about the Gs of this world. But really, particularly for my bank at least, that's an important customer segment, absolutely. But the bulk of my business and the majority of my revenue line is actually created by the Nordic SME sector.
Is it?
And that's really where we also making a lot of investments. To your point about the liquidity overview, to your point about how to create funding opportunities, and to your view also about the transparency, getting it into one single platform, and then some of that we find is interestingly enough coming from maybe the P2P market, where we have mobile solutions, we have efficiency in the way we deal with that, and that somehow transfers into what we then do. When, for instance, we have in the Nordics, we're in the process of signing up with some of the local suppliers of accounting services to these segments,
very good.
and integrating some of their ledger models into our solution to customers. So the plumber goes out and fixes something in my house, he will digitally transfer the invoice into my mobile phone. I'll swish it or whatever I do, and then the payment goes through. But not only that, it's actually booked into his accounting system, and then when he comes home, he can sit down and have his dinner instead of spending 2 hours trying to reconcile what he has been out during the day. So that's bringing. I think that's where the technology and our experiences in different segments cross over and creates opportunities.
So is it fair to say that cash management is actually more than just cash management these days? It's a wider thing of consulting, advising, particularly the SMEs, on how to wrap together various bits of architecture. So if they're small and they've got something, something equivalent of Sage software or Excel or whatever to do their accounts, that comes together, and then maybe that wraps into another working capital solution, like some form of receivables finance or approved payables. And so you can't say, well, that's cash, that's trade, that's that's working capital management. It's all coming together.
At least in my bank, there's a sorry.
That's right.
No, I just wanted to add, because I actually see what's happening. What you're saying here is happening with us. So the traditional cash manager is actually moving into a more advisory role in the discussion with the customer, isn't it? Because of what you just said.
So does that affect the skills and competences that your bank is looking for when it's bringing people in? So maybe more from the accounting and the consulting backgrounds that are coming in to help round out that experience for the client?
It does put other criteria to the folks we have in the banks. Absolutely. But it has to, because if you look at the consumers, my 25-year-old daughter has never been to a bank. And she has now starting with her first job, and the way she's getting about doing her things is totally different from what I used to do or what her older sister did. So there's something that we also as banks need to. We talked about it in the intro, right? Some of the things that we are seeing where the traditional banking model is being dismantled in the Western Hemisphere because of demographics and change of behavior. And that you guys, you're jumping that whole bit because you have the opportunity to jump right into the future.
Yeah, this is a very good moment, I think, to look a bit more closely at some of the initiatives in Africa on mobile phone payments. We had an excellent talk yesterday from Professor Jay Rosengard, who was talking about some of the work he'd been doing with M-Pesa in Kenya. But that technology is leapfrogging, isn't it?
Yes, I think so. If you look at it, obviously M-Pesa is the most or best known model. So a lot of similar models to M-Pesa have developed across the continent. I think it's obviously mobile technology allows the banks and also within the economies to play a more greater role in financial inclusion. I think Africa has been, for a number of years, there's been a segment of the population that has not been able to access or afford banking services. So through mobile technology, that opens up a much wider opportunity for them to become part of the system. I think there's still a fair amount, there's quite a lot that has been done, but I think there's still a lot more that can be done in terms of, for example, the integration. I think there are a lot of initiatives that have come up and they are operating in silos. So moving money between different wallets is still an issue. So there are a number of initiatives that are in progress to achieve some integrations that will allow exchange from one mobile wallet on one operator onto another one. In some countries, some services are being built onto the mobile solution, so it's gone from being sending money from A to B. You're now seeing loans, small value loans, running off the mobile platforms. So I think that there will be a lot more development as the technology improves and as people also look at how they can provide solutions to customers a lot better. So even in the development space, we are seeing the aid agencies looking at how they can get funds in remote areas, whether it's to refugees or to people in villages. But again, I think also the cost of the handset has to, at some point, also come to a level where it's easily affordable. So I think the old type of phones are cheap, but the smarter phones are still expensive. So gradually, as the phones become cheaper, that makes it much easier and gives the banks or the fintechs more flexibility to develop more and more solutions.
One of the things that came out of that session on mobile technology yesterday was the fact that it seems to work really well in a mobile environment when there are no other providers offering any kind of alternative, which is why M-Pesa took off so well in Kenya. In North America and in Europe, the banks serve their communities pretty well. Does that affect how something like mobile technology might or might not take off in those continents? Do you see an M-Pesa as a cash management solution coming forward in the Nordics or in North America? Probably. I mean, I'm not sure.
I would think that by having multiple providers, you have more competition, which is good, because it creates new ideas, new development. But it's also an obstacle to standardization, as we heard. For example, there is Hyperion, but you know there are 4 or 5 different Hyperions and protocols being developed. So whereas a network could be fairly standardized under a mobile technology solution, the underlying protocols are not. And if we don't manage to standardize that, I think it could become an obstacle to further development.
Standards.
Yeah.
Do you agree?
Yes. I think also that's a discussion on the standard side. It's a discussion also when you talk about blockchain, which we just had just before. I mean, when you had the distributed ledger technology, you know, you can have different distributed ledgers, and if you want to have some economy of scale, then you have the issue around what kind of standards are regulating this. But you asked the question: would it have the same? Would we see something similar in Europe or in the US as we see in Africa? I don't believe so. I think we're at a different stage. But what I'm seeing is, you know, the notion of the mobile wallet, isn't it? You know, and that's really in the consumer space rather than in the corporate space, of course. But again, as I said earlier with the other example I mentioned, I'm sure there will be some spillover effect, and eventually we will have a group treasurer sitting somewhere in the world totally dependent on his iPad or his whatever tablet he has, and expects to be able to do everything there, you know, just waiting for the next flight or having dinner somewhere in a more efficient way compared to what he can do today.
That's interesting. Shall we deep dive a bit into some of the fundamentals that we touched on earlier? The impact of the low interest rate environment. It is different in Africa. You've got a different set of interest rates going on, so that. But in Europe and in North America, Bank of England set it at 0.25%. Some banks are actually having to pay central banks to hold their money. How does that change what you're doing for your clients and what the end client experience is?
Yeah. If I may start, this has a very dramatic consequence to our business.
I wondered that.
We have had negative interest rates in Denmark for the last 2 years.
Yeah.
So overnight, if I have excess liquidity in my bank and I want to place it in the central bank, I pay to deposit 75 basis points overnight.
Yeah.
So obviously what we've had to do is to impose also on some of our more professional clients in the institutional space or in the corporate space the notion of negative interest rate, which is first of all difficult to explain
Yes.
It has some consequences on the technical side because I don't believe that we were totally ready for that in our system interfaces.
Oh,
so we had
right.
probably to develop some new features to accommodate for charging interests.
Of course.
And if you then take it a bit further, just as maybe an interesting observation, our mortgage system is based on issuing bonds, and we have actually on a few occasions have a negative coupon, meaning that a homeowner would receive a small check at the end of each quarter for borrowing money. So there's a few things here that's just mind-boggling. To the treasurer, it creates an issue, right? Because excess liquidity suddenly becomes a burden.
Expensive.
Yeah. So what does that create? And I think we're seeing in our neck of the woods where we now have Danish kroner, Swedish kroner, and partly euro also in negative territory. Corporates are now starting to look much more into, okay, so how can we rearrange our payment terms with our suppliers and arrange for prepayment and employ our own cash liquidity reserves more actively into our supply chain.
So it is intersecting very much with working capital management?
Yes.
More so than ever?
I mean, there's a clear link there, I believe, between...
Your experience, Dan?
Yes, first of all, if you look at the dollar, and dollar still being a driving currency globally, I think, at least for now. We can maybe talk about the renminbi later, but clearly the low interest rates are not sustainable because they are not generating the effects we had hoped for. So we expect an interest rate rise, maybe not this year, but most probably next year again. Yes, but I think it will happen, and we better anticipate of the impact of that, not only for the increase, but also those countries who still have a negative interest rate, including the euro. So the companies, the corporates, the banks need to prepare, but also the corporates. Now, again, I think some companies have more possibility to diversify their investments. They look into different asset classes. I take your point, who would invest in a negative interest rate. But I think the monies are being moved in, for example, real estate asset classes through funds being created in the market, also managed by us, but also by other banks. So, we have hedge funds also placing the funds, in fact, recapitalizing the fintech industry, because there is a big need for development. So the cash is ultimately funneled in other directions.
Okay, so I think, as we said, Africa is the opposite. So I think from an Africa perspective, I think the objective is to try and attract some of that liquidity which is excess in Europe. we can, I think, depending obviously on the countries, but the customers can earn a return on funds that they place with the banks in Africa. So instead of paying the bank for the bank to look after their money, at least in Africa, we pay a bit back to them. So that's on the foreign currency side. So we're trying to attract as much of the foreign currency liquidity as possible.
Well, the central bankers saying that they're getting quite a lot of inflows now because of your enhanced interest rates compared with the rest of the world.
I don't think at this point we've seen significant impact because I think there's an element. I think the corporates are still comfortable. They are more comfortable keeping their funds out. So it's a very long process of interaction and engagement to convince the corporates to consider keeping more of the funds in the various countries in Africa. But I think obviously it is the intention of the various financial institutions to continuously engage and attract as much of those inflows as possible. On the local currency side, the interest rates are much higher. In some cases, double digit, getting into 20% level and so forth. So I guess from a corporate treasurer perspective, they will get decent returns on any funds, that local currency funds that they invest or hold with any of the financial institutions.
Right, guys, that's where to put your money.
I raised my hand just to make a comment to this because I think it's really important to understand that this is the other equation of the treasurer's nightmare.
Yeah.
Because yes, he in his home currency he's getting no or low yields, and then there's a fantastic alternative, but then he incurs an FX risk. exposure,
This does need
or go into a
Yes.
different asset class, and then suddenly
Yes.
he's outside his risk
Yeah,
mandate.
yeah.
So this is another discussion that we as banks would have with our corporate clients.
So maybe not the Kenyan shilling. or-
Well, it might be, and there might be very good opportunities. Absolutely. So I'm not,
Yes.
I'm definitely not disputing that. But I'm just going back to our agenda point here. What
I think that's a very good
corporates
point.
has that-
You have kindly taken us to the next part of our discussion, which is the FX risk and how what sort of hedging is going on and how you're managing that and all the other stuff that's going on. So is that more of a challenge at the moment than before, or less? And how does the interest rate compression perhaps make treasurers look for more better paying places to put their cash, and suddenly you're doing more of this FX management? Or is it just sort of always an issue, nothing special?
Well, if we look at the customer, let's look at the customer.
Let's go back to the
Yes.
customer. Always good.
For them, the hedging strategy is dependent on the working capital cycle
Yeah.
and also the information they can obtain. So putting it in context of the fintechs and what we discussed earlier, it would allow them to determine that exposure much earlier in the cycle and reduce the risk. So there is an important cost element here in favor of the customer.
Is that your experience? Thoughts?
Yeah, no, I think it's right, and I don't think it's become more difficult to manage than before. I think actually there are better tools available for the corporates to manage this. There are volatility out there, and of course, when corporates look for opportunities, maybe in markets that are new to them, obviously it creates new opportunities, but also new risk elements that needs to be monitored. I think that both as banks we have had good opportunities to manage this in the past, and as is mentioned, there are of course new players coming in that are also offering those services.
But of course, the corporate doesn't only bank with one bank.
No.
I just remember, I remember talking some time back. Here we are, we're in Geneva, and it's the home to the commodity traders.
Yes.
There's a lot of them here, and Trafigura once said that they had in excess of 100 banking lines. There's about a core 20 who are their sort of bigger banks and the more day-to-day relationships, but they have that many banking relationships. So how do you guys work in a multi-bank environment? We're looking at some of these things of managing liquidity, FX, and all that stuff.
So I think we, at least from our perspective, because we are more of a regional bank.
Yeah.
So if you are looking at probably your example of a Trafigura, they've got their global bank. So in terms of providing services to them across Africa, I think a lot of would be structured around the client requirements. So we have the flexibility to feed whatever information they need to get into their global bank. We have the capability to also centralize or consolidate that information within Africa. Also setting up of lines for their Africa requirements. So lines which they can use across, so a single limit that covers them across the entire continent. We do work or collaborate with a number of the banks within Africa and outside of Africa. So I would say they are close relationships, both from a cash and also from a trade perspective, to support the needs of these various clients.
No, I think that's. I would be able to say exactly the same thing as a regional player as well, and we have over the history of our bank worked with corporates that have that same strategy as you just mentioned with your example, where we play with a big global overlay structure, right?
Yeah.
But I think, and I might I'd be willing to, I'm interested to hear what you guys are saying on this. But I'm seeing maybe that there is a stronger wish from many corporates to have a number of strong regional banks close in the banking group to service the regional needs and maybe decrease the dependency on the large global relationship. And I think maybe as an outcome of the financial crisis and the turmoil among some big banks, that the regional banks has become or has been given a different role in the corporate context, and then that creates, of course, other areas of issues, I guess, about liquidity management, about FX exposure, where the corporate then would have that in-house, if you will, and have a structure that put in place where banks can support that, but where we maybe feed in to a sort of an internal liquidity management structure or risk hedging structure in the corporate space.
The other thing that's come through is some of the research that's been done on reluctance to repatriate cash. And there was a Deloitte survey, wasn't there? I think it was sometime last year, where it noted that Credit Suisse had estimated the amounts repatriated or earmarked for repatriation were around 300 billion US in 2014. And there was a JP Morgan report, wasn't there, about how Apple, for example, is holding about 89% of its total cash overseas. So do you run into some of this, where you've got corporates that actually don't want to rush to get their cash repatriated because of prevailing tax conditions or what? How does that work?
I think you have to realize that corporates would have different drivers. We just touched upon a few here with the interest rates and with the FX conversion. But you mentioned now the tax issue, which is a very important driver to many global corporates. And I'm not a specialist, so I won't go too deep into that.
Don't worry, I don't think I am either.
But obviously the corporate are looking at the whole aspect of his business, and the treasurer has many tasks also out and beyond the banking relationship. So I guess that's where we are not going to be a tax advisor I mean, other colleagues of mine are corporate advisors to a different degree. So mergers and acquisitions, of course, is also part of that discussion. And how do you position that for a potential new acquisition? You know, do you want to keep some cash stashed away to buy into your physical supply chain, or different things, different drivers there that could be a reason why that they don't repatriate as much as you.
So you kind of wait for advice from other parts of the organisation to.
I'm just saying it could be different drivers.
Yeah.
But I would agree with Søren in that there is a lot of trapped cash out there for various reasons, whether it's tax, regulatory, local investment policy. It's not up to the banks to drive this necessarily. We could facilitate the process, but I think it's very much about global tax harmonization. If we see what's happening lately with the Apples and the Starbucks and the special tax treaties and all that, so that could unlock that trapped cash as well, and maybe steer it into, for example, Africa. So why not?
What do you think about that?
So I think from just touching on the trapped cash aspect, slightly different from our side. So we'd love to have that cash flowing in from Europe, obviously. But I think what we see a lot of is a number of the corporates who have generated significant cash in the various countries, and they're trying to get it out of the countries. And they do struggle quite a bit, and it's just purely from a euro-dollar liquidity. The various countries just don't have enough to open up and remove restrictions on foreign currency. There are a few countries which are flexible. You can move money in and out, but for a lot of countries, there are controls in terms of what you can send in and at what point you can. So what you can send out and at what point and for what purposes. So we find that a lot of the big corporates tend to find that quite frustrating. But it's just if you open up some of the systems and just allow a couple of the big players to move significant amounts, you probably will not have any foreign currency left for the rest of the economy. So I guess there needs to be that balance between the corporate needs and the overall country's FX strategic reserves.
No, exactly my point. I mean, Nigeria has been in the press, right? Around the US dollar positions, and lots of corporates, or a number of corporates, would have reserves tied into the Nigerian subsidiaries for that same reason.
And the other thing, let's go back to Africa, sorry guys, in that you've got certain countries where they've been used to dollars coming in through sales of hydrocarbons, and collapse in commodity prices has changed that picture a bit. How does that affect some of the cash management and the sort of dollar shortage issues facing some of the African corporates?
Yeah, so I think again it's tying cash and trade,
Yes,
because
exactly.
yes,
That's
because a lot of
together,
yes, yeah. So that linkage. So you find that in Nigeria is a good example of that, where when oil was sitting at 100 plus, there was a lot of foreign currency flowing in, and now at $50, the situation is a lot more challenging. So it is your cross-border or out of the country outgoing payments. You tend to then see a queue building up, and Nigeria is recently, there was a time when it was extremely difficult to get any payment out, but they've recently allowed the currency to devalue to a certain level, and there is an auction, the auction system is back up and running. So the corporates can put in a bid for foreign currency, and based on the auction, the foreign currency is released. So we are seeing a reduction in the number of outstanding payments, but obviously the issue of limited foreign currency inflows will continue to make the situation difficult. There are also a lot of efforts in terms of the economies have to diversify for a number of countries, and I think once the economies diversify and you've got a wider export base, you're not just relying on the resources, the mining resources, the oil. I think it will create a better balance for the economies in Africa. Yes, yeah.
Right, great. I'd like to move on a bit more to, or rather come back to some of these regulatory systems that we touched on earlier, and some of the controls and the standards that are in place and that need to be in place to deploy some of this technology. So we've had things like in Europe. We've had SEPA that's come through. That seems to be a distant memory almost, but it was a lot of work at the time. And all the bank systems had to be completely re-overhauled, and so on. And what was interesting about SEPA, from my perspective as a journalist, was that there was absolutely no wriggle room. You all had to do it. You were given a deadline, and everybody got on with it. Yeah. Do you think there'll be as forceful an initiative elsewhere in the cash space in the future, or has SEPA kind of been it? Sorry, this is not Africa, this is Europe, but the principle of SEPA, the principle of something enormous like that, just imposing a lot of investment that you all had to make pretty quickly, is an interesting one.
Well, SEPA was a European initiative, yes, but it does have impact on the global flows, and so will PSD2 as a new discussion point. There's been lots of sessions at Cyprus around PSD2, and this is also not just a European issue, because there's this notion of one leg in or one leg out, you know, which will have some consequence to how we as banks create systems to facilitate our customers' traffic, and it will have other consequences. So regulatory is very much an important part of how we drive this forward. Here you can also have the discussion around the fintechs or the non-bank players coming into space, where traditionally banks has been, because we will have with the PSD2 also to a certain degree open up on the information we have in the banks around the customers, and that will create new dynamics, both giving us opportunities, but also giving other players opportunities. So I think the regulatory issues are there. The relevance to us is really highly relevant, and you can choose and say it's a big problem, we're never going to survive, or you can see it as an opportunity. And I think most of the buzz around this topic at this conference at least was very, okay, let's look at the opportunities and see how we can apply this into new solutions.
What do you think the opportunities are?
Yeah, well, we clearly see the emergence of new standards, because that was, I believe, your base question.
It
If we look at it globally, I would say if you take China, for example, you have SIPs and the other end, the equivalent also in China. And so one is domestic, so SIPs is cross-border, domestic it's KNAPs. I think in Africa, because the infrastructure is different, and so, for example, implementing SEPA in Africa, does it make sense? No, I don't think so. But there you see the standard coming out of technology, like mobile payment technology as a standard. I think in Latin America we may see the same thing. If you take the Americas, so US and Canada, it's very much about real-time processing, real-time payments. There has already been ACH, so the low-value clearing on a same-day basis. So we see that, and I think it's a prerequisite in order to enhance that trade, whether it's intra-region or also giving access to external parties. And so for PSD2, leg in, leg out. But the Americans need to participate in the European system, or the Africans, and likewise we need to be able to participate to their regional economy.
Let's jump on to SIPs, which came up with Cybos last year, didn't it? Because it had just been announced, and it was quite a change from the previous regime. And there was lots of talk at the time about how this might actually bypass getting through SWIFT at all. It wasn't quite, I think that sort of went away again. But those of you dealing in RMB or with an interest in working with the Chinese, how do you see what they've done in SIPs as being a shape of things to come?
Yes, if I may address that in first instance, and I would also be interested in Nkozi's view on Africa on that, because from our perspective, and I'm talking now more from a developed world perspective, I think we see a disconnect between the figures being delivered to us in terms of usage of RMB, whether it's onshore or offshore, through Hong Kong or not, or through the local clearings. Some people say that intra-Asia, 45% of the traffic is now transacted in renminbi. Well, we don't see that. No. We don't have those requests from our customers, be it financial institutions or corporates through those financial institutions. We don't see it.
I feel a bit uncomfortable without a Chinese bank here to stand up for the RMB, but there we are. What do you think?
So I think there's a lot of trade flows between China and Africa. It's quite significant. But in terms of the transactions, we tend to see more dollar denominated than RMB denominated. So again, at Cybos, with the Chinese banks that we met, our discussion was around how we can jointly look at making it easier for someone in Africa who wants to pay their counterparty in RMB to be able to do that. So I think there's a lot of work that needs to be done on both sides to at least transfer some of the USD flows to having a direct flow between a particular African currency and RMB instead of going through the dollar each time.
We have very limited experience from our bank, and the region has very limited flows in and out of China in renminbi. It is really dollar and euro predominantly. We can trade both on and offshore. We can advise our customers in those. We have had numerous seminars and discussions with the Nordic customer base around this, but it has a very, very slow uptake.
I would also like to add to that. Renminbi may be used for capital markets purposes, but on the commercial side, I believe it still creates a hedging and exposure management problem. Because the fundamental question is there a competitive market for foreign exchange dealing against the renminbi compared to the dollar or the euro, even against those currencies? And if, for example, in Africa, because there is that corridor with China, you have those trade flows, you have an advantage in paying renminbi, but you end up with the hedging, so you may negotiate a cheaper price, but you have the hedging cost. But then how do you deal with it? How do you offset that risk in the market and with counterparts and with your banks?
Goodness. Right, as we come towards the end of this very engaging discussion, I thought we would come back to the TFR routes of trade. and where the intersect points are in terms of cash management and trade and working capital finance. We've already heard how it does intersect in terms of the supply chain finance, the receivable finance opportunities, where there is a lack of clarity about how much cash to hold and what's going to be needed when. So if they haven't got enough, there'll be a receivables finance solution, perhaps which you could charge better fees for, I don't know. but there's all of that going on. But what are the other intersections?
So I think from an Africa perspective, so if you start, there is the formal trade, your big corporates, your SMEs, and the big entities, but there's also a lot of informal trade, a lot of individuals or very small companies who can be trading domestically or cross-border. So you still find a lot of cash moving between countries. So a number of banks, including ourselves, are looking at how we can make it easier for anyone who is involved in trade to do their business more efficiently. And a lot of that is the linkages between cash and trade. How do the solutions from a cash perspective support that trade business? So whether it's a payment of a mobile wallet or mobile phone, can a person use their card more readily? Are the points accessible where someone can use their card? How quickly can you move funds between countries? And when you're moving the funds, can you assist the beneficiaries to reconcile what's coming through so that they can release the goods? So I think we see a lot of linkages, and we are spending a lot of time on what we call from a digital strategy, just trying to see how we can make the transactions as electronic as possible, whether it's electronic trade from an electronic platform for the big corporates or electronic financial supply chain to the person at the lower end of the scale who still needs efficiency to be able to complete their business transactions securely and safely.
How are you managing to incentivize SMEs or growers or little corporates to get away from their suitcases of cash and to come out of the informal system into a system where their trade can be monitored and can actually be counted for GDP purposes? Because that's what's missing at the moment, isn't it? You've actually got a false picture of the amount of business that really is going on because you don't see it.
Yes, so I think that there's the aspect of, obviously we have to provide the right solutions.
Yes.
So we actually, at the moment, for example, we are rolling out a mobile solution that's standard across all our 30 plus countries, because that will make it easier for us to provide the next layer of solutions with that standardized framework. We also, within the bank, we have a specific unit that looks at financial inclusion. So that would look at banking needs and solutions for that segment of the market. And I think gradually, as you get more and more of that market formalized in a way, because that's what I think in Europe you probably find the SMEs are the drivers of the economy. And I think in Africa we need to get to that stage where you're starting out at the lower level and you're assisting them to grow their businesses to the next level, and you're also assisting the SMEs to reach the next level. And obviously a lot of what we do from a trade perspective also depends on the support that we receive from our correspondent banks. So we spend a lot of time with the correspondent banks because Africa still imports more from outside of Africa than from within Africa. The trade between the African countries is less than the trade between Africa, Europe, and China.
It consumes what it does not produce, and it produces what it does not consume.
Yes. So for someone who's importing from Africa, we would need a bank if he's importing from Denmark or wherever. We need a bank in Denmark to support with the confirmations of the LCs and everything else. So So we do interact quite a lot, and we receive a lot of support from our correspondent banks to facilitate those trade flows.
Okay. I'd like to hear from Daniel a bit more about your intersections on the trade and the cash side, and how you see that playing out a bit more, perhaps.
Yeah, I believe we have seen a stronger convergence between cash and trade.
Yes.
But we have now also noted that with the recession, there is increased sovereign and counterparty risk, and that needs to be mitigated. Yeah. And that also creates an obstacle for trade flow, so that convergence is suffering from it. I believe at one point we had hoped to see a meaningful reduction in traditional trade, LCs, yes, with confirmations and discounting. But on the contrary, it's still very much prevailing, depending on the trade corridors. I also think that the complexities of a trade value chain are still there, whether because of the documentation, logistical matters, the warehousing of goods. And again, technology could be an enabler here through digitization, maybe blockchain again, or another format, to recreate that convergence between cash and the predictability also of the cash flows in the system.
Yes. Sorry?
No, I think it's difficult to add what has been said here. I would just maybe pick up on the digitalization.
Yes.
Over the years, there has been a lot of discussions around how could we digitalize the letter of credit. SWIFT and ICC tried with the bank payment obligation, which didn't really fly or take off.
No.
I think we've all been involved in use cases over the last year on the blockchain technology,
yes,
to see if we can actually use that through the distributed letter technology, maybe to create some efficiencies. And I'm just sure with all the initiatives going on, we will see some good things coming out of this, which will not necessarily transform the letter of credit business into pure cash or the other way in, but will facilitate. You ask for how do we initiate, how do we make it interesting for the corporates and the consumers to use this. We do that by making it easier, in a digital format, in one platform, with transparency and with some kind of standards. Then that's the incentive that customers want.
It's quite tough, isn't it, to be innovative and to take risks when in a bank your livelihood is risk management and making sure things don't go wrong. And then in an innovation hub, it's all about being brave enough to fail and giving things a go and trying lots of proofs of concepts and prototypes until you get to the right solution.
Not all banks are boring, Clarissa. But
I've got three of the most exciting.
We could lose the jacket and the tie. No. But I think what we've done is to answer your question in a more formal way, maybe.
Yes.
In our IT and development area, we basically have two types of developers, right? We have those that make sure that the bank is running every morning when we come in and we turn on the switch, right? And then we have the other guys who might never wear a tie and may come in sometime during the day, or may actually sit and develop, somewhere else, and then just communicate. So I think we have that. That's a convergence, I guess, about the fintechs and the banks.
Excellent.
Yeah. So
roller skates.
You've got roller skates on your guys.
Yeah. But it's happening.
Yeah, and one of the big themes I thought was how the importance of the integration of innovation into business as usual, rather than in some little hub somewhere, and don't sort of sully business as usual. So it was just an observation about this year's Cybos. As we come to an end of this absolutely fascinating discussion, I wondered if we could close with a thought from each of you on where cash management is going. How do you see the next 12 months? How do you see the next 3 years? Will it be a very different architectural experience, or will it be a sort of evolution of what we've got now? What do you think?
Well, I would say, may sound maybe as a cliche, but we should embrace technology, look forward and work collaboratively with the fintechs, but also among the banks. That's clearly the future. We cannot work in isolation anymore.
And the regulators.
Yes, but I think the regulators are there to steer whatever we develop. I'm not sure that regulators should impose things, but that's maybe a liberal view.
Do you agree with that?
Well, I agree that the framework should be set.
Yes.
And we need to operate within that framework. And then sometimes maybe we could ask them to move the borders a little bit one way or the other, but there has to be a framework. I think coming back to your question, then I would say that where I'm seeing these things, the cash management is there to stay, liquidity management is there to stay, FX risk management is there to stay, and there's a clear relationship over to trade, supply chain, all other services that is on the treasurer's agenda. And I think from banks, I think I stated it earlier, the role is changing into becoming more consultative in the face of our customers. And we need to understand what's the customer's real physical supply chain, what are his main concerns, how do we then talk to him about those, and then as part of the solution we will have liquidity management, cash management, and all the rest.
You get the last word, because
So I think from an Africa perspective, I think we'll probably see more of the digital solutions, greater push, but within that to get more efficiencies. I think it's important for the various systems, not just on the bank side, on the fintech side, but also in terms of how we interface with clients, just getting to a point where the processes are a lot quicker in terms of getting to a solution for a client. And I think that's where some of the standards come in, because I guess if certain standards are adopted on both sides, all the parties will be able to deliver solutions a lot quicker. So a lot of the emphasis within Africa is move cash and checks onto electronic channels, and I think a lot of the banks will be focusing on that in the next 12 months in terms of the cash management space. There will still be, obviously, I think from a new technology perspective, I think the conversations over blockchain will take a bit of time to crystallize. I don't expect to see any massive change in the next 12 months, but I think the interest has been generated, and the market awareness will build going forward.
Thanks very much. Well, to conclude, some of the big themes that have come out from the discussion we've just had is that the fundamentals for cash management don't change. FX will always be an issue in terms of managing the volatility, the day-to-day liquidity management. Have you got enough cash to meet the existing liabilities, and what happens with what's sitting around? And it's actually getting quite expensive to have it sit around these days, so that's an ongoing challenge. And also dealing with various bits of regulation that are coming in. We've had CPERM, we've got other challenges going on there. So there's a lot going on, but in terms of the development of this space, it's working together with fintechs, it's working together with regulators who we've already agreed can't actually run the show. They need to provide a helpful framework, and getting transactions out of the informal space in Africa into a space that can be measured, and support services to encourage them to do that. I hope you'll all agree that it's been the most stimulating discussion. It's been great to get together after Cybos. I'd like to thank our panellists very, very much for joining us here at TFR today.
Thank you.
Yeah, thanks, Larry.